We have shown how benchmarking identifies where your margin is. This video is about how you keep it. Tax optimization isn't about last-minute deductions. It's about structuring income and decisions throughout the year to produce the best after-tax outcomes over the long term. Tax planning becomes more powerful when you zoom out and look at the long-term horizon. The objective is not merely to find deductions. It is to make sure that practice decisions produce the best after-tax outcome over the long term, without creating compliance and administrative costs. A common mistake is treating tax planning as a one-time event at the end of the year, instead of embedding it in your operating model. When coordinated, these elements reinforce each other. When not, they create missed opportunities or last-minute scrambling. So I want to talk about some of the tax opportunities you have as a practice owner. You've got a lot of levers you can pull, and a lot of your deductions are going to be, standard business deductions that you're just running through your practice as your normal overhead. But there's a lot more on top of that you want to make sure you're not missing out on. First, ensure that you have the best entity structure for your income level. The default for practice owners is typically to be treated as an S Corp, but this is not always going to save you taxes at certain income levels. You should have that analyzed and make sure that that is the right entity for you and not just go into the default. If you are an S corporation, optimize your salary that you pay yourself as an owner. Right? You don't want to pay yourself too high or too low of salary. We help our clients determine where that optimization point is. S corporations or partnerships in high tax states should utilize the pass-through entity tax. This is going to save you money on your federal tax return because in a lot of scenarios, you're not going to be able to deduct your state or local income taxes that you pay unless you opt into the pass-through entity tax through your partnership or your corporation. If you are an S Corp, you could rent your home to your corporation for board meetings. This could be done monthly, maybe it's done quarterly, right? There are ways to get write-off for the use of your home for business that you're legitimately using. And so we help our clients substantiate that and would be able to defend that use of home, whether you're an S corporation or a sole proprietor taking the home office deduction. Another thing you should consider if you have family is running payroll for family members. This could be maybe your children, this could be a spouse. What should you pay your family members? And why does it make sense? And how can you substantiate that so if the IRS ever looked at it, you don't get in trouble? So in certain years, as a practice owner, you may have substantial equipment purchases, you might have practice renovations, you might be eligible for credits that have unique tax treatments. Those are kind of one-off things that aren't going to be available to you every single year, year over year. And so it's super important to be thoughtful about those. A lot of people just default to those one-time things and just write the whole thing off up front, trying to save as much tax they can in that year. It's not always the smartest way to approach those write-offs. So recognize those years, recognize if you have those unique opportunities to draw your income lower than average. If you are going to have a year like that, focus on not just the tax savings that year, but the long-term decision making. Those years where you could drop your income lower than average might create unusual planning windows. And when that income drops below average, let's say you're typically in the 35% bracket and something happens to where you can drop down in the 22% tax bracket. That's what I'm talking about. Something that would have a significant impact to your tax situation. We want to know about those up front. So some examples of situations or opportunities where you might be able to drop income is if you're a practice owner and you're taking several months off for maternity leave and leveraging an associate that pushes your profitability down closer to a break-even point for a while. Another one could be a practice purchase, right? If you've been associating at another practice and mid-year you're going to buy a practice for $1 million, you might have $250,000 or maybe even higher worth of equipment write-offs that you'll be able to write off in that year of practice purchase that give you substantial savings opportunities. Another one might be a real estate acquisition opportunity with large depreciation write-offs. And so when we talk about tax optimization, it only works when you ensure that you're getting the best bang for your buck on your write-offs. Right? We don't want to burn your write-offs. We don't want to waste your write-offs at low tax rates. So if you have a real estate purchase where you can drop your income $300,000 and essentially pay zero in tax, we may not want to do that because you would be using that huge write-off at low tax rates, right? We want to make sure that that write-off is not wasted and that it's utilized at higher tax rates. This is where that integration of tax and wealth becomes so important. If you have a $300,000 write-off from a real estate acquisition opportunity, we may want to do Roth conversions and see if you have any money in your 401k or IRAs that we could convert to Roth. A Roth conversion is taxable. It drives up income. And that way, you're doing a conversion at a really low rate that you drove via your depreciation write-offs. That is a perfect example of aligning your tax and wealth to optimize your tax situation and your overall financial plan. Retirement plan strategies are a core lever for your tax strategy. Another situation where you might integrate your tax and wealth would be in those years where you decide to fund a Roth 401k instead of a traditional 401k. If you can drop your tax bracket, it might be more beneficial to not get a tax deduction for your 401k contribution that year and put it into Roth where it can grow tax-free. You have a lot of different retirement plan options as a practice owner. You have profit sharing plans, you have IRAs, simple IRAs, cash balance plans. Those all can be core levers to pull your tax bracket down or up, depending on how much you're going to fund year by year, and really give you some good planning opportunities. The contribution timing of your contributions that you make towards your employer portion of your retirement plan funding also has a lot of flexibility because you don't have to fund your retirement plan for the employer portion until the extended deadline of your tax return. So if you go on extension, you have all the way until September 15th of the following year to fund those plans, which really give you a lot of flexibility with cash flow year over year and planning around these one-time items. This is where owners often leave money on the table, especially in years where compensation or profitability patterns are unusual. The retirement plan options and the depreciation options and conversions to Roth can be very powerful vehicles if they're integrated together. If you are a practice owner, meet with an earned advisor to align owner income, retirement contributions, and tax planning into one coordinated system that improves after-tax outcomes without adding additional operational friction.